Beyond the familiar world of banks lies a $200 trillion shadow financial system, operating in regulatory gray areas and creating risks that could dwarf the 2008 crisis. This parallel financial universe functions alongside traditional banking, performing similar functions but without the same oversight or safety nets. Shadow banking encompasses any financial activity that occurs outside the regulated banking system. This includes hedge funds engaging in complex derivatives trading, private equity firms leveraging buyouts, money market funds offering bank-like services, and even peer-to-peer lending platforms. What unites them is their operation beyond traditional banking regulations. The scale of shadow banking is staggering, growing from virtually nothing in the 1980s to over $200 trillion today. To put this in perspective, the entire global GDP is about $100 trillion, meaning shadow banking is twice the size of the entire world's annual economic output. This growth has been driven by financial innovation and regulatory arbitrage. The key players in this hidden economy include massive hedge funds like Bridgewater Associates, private equity giants like Blackstone, and money market funds that collectively manage trillions. These institutions perform banking functions like lending and credit creation but operate with different rules and far less transparency than traditional banks. The 2008 financial crisis revealed how deeply shadow banking was intertwined with the traditional system. The collapse of Lehman Brothers and the bailout of AIG exposed how shadow banking activities like mortgage-backed securities and credit default swaps had created a house of cards that nearly brought down the global economy. Current regulatory frameworks struggle to monitor shadow banking risks. The Dodd-Frank Act in the US and Basel III internationally created new regulations, but significant gaps remain. Many shadow banking activities occur in offshore centers or through complex legal structures that evade national oversight. China's shadow banking system presents unique global risks. With an estimated $15 trillion in shadow banking assets, China's system has grown rapidly through wealth management products and informal lending. The opacity of China's financial system means the true scale of risk remains unknown to international regulators. The systemic danger lies in the interconnectedness between shadow and traditional banking. When shadow banking institutions face liquidity crises, they can trigger chain reactions that spread to regulated banks. The 2008 crisis demonstrated how quickly problems in one part of the system can infect the entire financial ecosystem. Reform efforts face enormous challenges. International bodies like the Financial Stability Board attempt to coordinate oversight, but national interests and the constant innovation of financial products make regulation a perpetual game of catch-up. The very nature of shadow banking makes it resistant to traditional regulatory approaches. The shadow banking system represents both financial innovation's cutting edge and its most dangerous frontier, creating a parallel economy that regulators struggle to understand, much less control. As this hidden system continues to grow, the question remains whether we're building a more resilient financial world or simply creating the next crisis in waiting.